Hi, Jonathan York from Bay Financial Partners, looking at investment markets. Now looks pretty much a slam dunk for the Fed that they will raise interest rates after the latest unemployment data from the US. Certainly, again, a very strong set of data coming through with pretty good job creation. Also, a little bit of wage inflation coming through as well. Maybe not quite as much as some sort of economists and analysts would like, but it is still in the numbers. Also interesting to note as well, there's a little bit of upward revision to some of the previous numbers as well, which put about another 40-odd thousand jobs on the table there. So really is pretty strong data coming out of the US, and most people now expect the Fed to raise interest rates by a quarter point at the meeting next week. Big question is what sort of scale and pace we see on the further rate rises. Some economists are looking for another rate increase within the first quarter. Others are sort of saying that we're going to have a sort of sit back and wait and see policy and just see how it sort of pans out. And maybe just weighing on that could just be the inflationary pressures. Obviously, as oil dips below that $40 a barrel, commodities under further pressure as well. Inflation really doesn't seem to be too sort of rampant out there in these global economies. But then I say, you flip the sort of coin over and just look at that wage push inflation, and if you are close to full employment in the US, which around sort of 5% unemployment is deemed as pretty close to full employment, you are then going to start to see a little bit of maybe wage cost inflation coming through, and that could just be the trigger for some further rate increases. Overall, markets seemed a little bit disappointed by the ECB. Yes, they did extend their quantitative easing, but it was viewed as a little bit disappointing. Well, what it did do is give Draghi allow him to keep a little bit of powder dry in case he does need to pull the trigger a little bit further down the road. So in this low interest rate environment, it does seem pretty good for equities going forward, and it'll just be interesting to see how they sort of trade into the year end. So far, they seem to be sort of holding a reasonable bid. There's always a little bit of nervousness out there, but most economists are looking for still a slightly positive 2016. Here in New Zealand, obviously we've still got the Reserve Bank to meet later this week. Again, it'll be interesting to see if they do anything on interest rates. It appears the Auckland housing market is coming off the ball just a little bit, and that always been put up as a pretty good excuse to why interest rates won't be cut further. But if you look at it, mortgage rates are still pretty low, and indeed now below that sort of 4% for a 1-year fixed. And so even if they do cut interest rates, the only one that will probably be suffering out there will probably be the savers. So it does look a pretty close call for this week. And certainly with the pressure coming on those deposit rates, as we've discussed many times, there are plenty of options out there for income. And if you're interested in those, call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz.